Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. For investors, one of the most important concepts is risk. You might have heard the term high risk, high returns, or low risk, low returns. Well, most of the times, investors are looking for low risk and high returns. In the world of investing, it is extremely important to manage risks. In this video, let's take a look at what Mr. Seth Klarman, one of the greatest value investors of all times, has to say about managing risks. Before we start, please smash that like button and make sure to subscribe to receive more such videos from great investors. Also, make sure to check out our playlist, which has plenty of lessons from super investors in the description below. Now let's dive into how Mr. Klarman views risks. He says that Baupost, the investment fund run by Mr. Klarman, Baupost's investment approach is highly risk-averse. We continuously worry about what can go wrong with each investment and the portfolio as a whole. Avoiding and managing risks is a 24/7/365 obsession for us. Our general predisposition is that we ought to run our money as if it is our own. The best investors do not target return. They focus first and foremost on risk and only then decide whether the projected return justifies taking each particular risk. Right at the core, the mainstream investors have it backwards. Mr. Warren Buffett often quips that the first rule of investing is not to lose money, and the second rule is to not forget the first rule. Yet, very few investors approach the world with such strict standards of risk avoidance. We try to focus on the downside. We diversify. We try to look into places that other people don't consider. We clear a high bar before making an investment, and we resist the many pressures that other investors surely feel to lower that bar. The prospective returns must always be generous related to the risks incurred. For receiving investments, the upside potential must be many multiples of any potential loss. Leverage does not have to be dangerous. Non-recourse debt on an asset can serve to make a large purchase more affordable. Taking out a non-recourse loan on an already owned asset can actually reduce risk. There is also a bit of a slippery slope in that if a little leverage is a good thing, is more leverage better? When do you stop? Investors should always keep in mind that the most important metric is not the returns achieved, but the returns weighted against the risks incurred. Ultimately, nothing should be more important to investors than the ability to sleep soundly at night. People invest without much attention to risk because risk is unpleasant to contemplate and difficult to measure. The latest trade of the security creates a dangerous illusion that its market price approximates its true value. This mirage is especially dangerous during periods of market exuberance. The concept of private market value as an anchor to the proper valuation for business can also be greatly skewed during excess of times and should always be considered with a healthy degree of skepticism. This is something we definitely saw during the 2020 and 2021 boom in the stock market prices. You rarely, if ever, make money from worrying. If it does not typically enhance return, but by avoiding loss, you're able to hang on to what you have accumulated, which is a cornerstone of successful investing. For now, that's it from us. Hope you enjoyed and learned from these small nuggets of wisdom. Please smash that like button, and for more wisdom from great investors, check out the description below or the playlist above, or head to the channel's page and subscribe to make sure you receive follow-up videos. Thanks for watching.